Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CEVA Inc. quarterly report. CEVA Inc. offers a wide range of businesses and services that cater to the semiconductor and original equipment manufacturer industries. At the forefront of their offerings are silicon and software intellectual property, IP solutions for various applications. One key area of focus is 5G and 5G advanced technology, where CEVA provides several solutions such as Pentagiran, CEVA XC20 DSPS, CEVA B X2O baseband processor, CEVA XC21, and CEVA XC23. These solutions support mobile broadband, RedCap, IoT devices, and cellular infrastructure system on chips, (SoCS). In addition to 5G technology, CEVA also offers a range of other services including Wi-Fi platforms, ultra-wideband platforms, Bluetooth platforms, and connectivity standards for SoCs. Their CEVA Waves platform provides solutions for various processes and nodes, while their Dragonfly platform is a turnkey solution for implementing NB-IoT cellular modem SoCs. Furthermore, CEVA offers audio-digital signal controller IP, noise cancellation software, spatial audio and head tracking software, sensor fusion software, and neural processing unit, NPU, IPs for generative AI and embedded AI. Their CEVA Pro Studio is a software development environment for developing and deploying AI models on their NPUs. Overall, CEVA's diverse range of businesses and services enables them to cater to the complex needs of semiconductor and original equipment manufacturer companies worldwide. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth in recent times can be attributed to several key factors. One significant contributor has been the increase in licensing and related revenues, which saw an 18% rise. This growth is also driven by the expansion of value per customer through integrated system-level solutions. Furthermore, the adoption of AI-related licensing agreements has been a major factor, with AI representing over 20% of licensing and related revenues. The growth of various wireless technologies has also played a crucial role in driving revenue up. Wi-Fi shipments have seen a remarkable 158% year-over-year increase, while Bluetooth adoption continues to expand across multiple end markets. Additionally, the cellular IoT market has experienced a 38% year-over-year increase. The growth of AI-driven royalties is another significant factor, with notable examples including mass-volume automotive AI deployment at Toyota and ramping AI SoC for surveillance. Overall, these factors have collectively contributed to revenue growth, making them the primary drivers of this trend. The net income of the company experienced a significant increase in the first quarter of 2026 compared to the same period in 2025. Specifically, it rose by $300,000, representing a notable 30% growth. This upward trend is a positive indicator for the company's financial health. On the other hand, profit margins did not undergo any changes during this period. The gross margin remained constant at 86% for both quarters, indicating that the company's pricing strategy and cost management were effective in maintaining its profitability levels. The company's financial performance is a cause for concern, as it is not generating positive operating cash flow. The data from page 15 and page 16 clearly indicates that the company has been using more cash than it generates, resulting in negative operating cash flow of minus $4.9 million in 2026. This trend continues into the first 3 months of 2026, with a net cash used in operating activities of $15.8 million. These figures suggest that the company is struggling to manage its finances effectively and may need to reassess its operations to improve its cash flow situation. The company's debt level has undergone a notable change in recent months. According to financial reports, the debt level decreased by $6.3 million from December 31, 2025 to March 31, 2026. This reduction suggests that the company has made efforts to manage its debt and improve its financial stability. However, upon closer examination of other pages, it appears that there are conflicting statements regarding the significance of this change. Despite the decrease in debt level, some reports indicate that there have been no significant changes in the company's debt situation. This discrepancy may be due to varying perspectives on what constitutes a significant change. In conclusion, while the company's debt level has decreased by $6.3 million, the overall impact of this change is unclear due to conflicting information. Further analysis would be necessary to fully understand the implications of this shift in the company's financial situation. Management is optimistic about the company's outlook, citing its position at the center of key megatrends. The company's portfolio continues to drive strong interest in its intellectual property, IP, portfolio, with key milestones including securing a licensing agreement for a full Bluetooth 7 integrated solution and introducing a PentaG-NTN 5G advanced modem platform. The company is well positioned for sustained growth due to its diversified royalty streams and broad range of advanced semiconductor packages. It expects to capture secular growth across various markets through its physical AI solutions. However, management notes that a significant portion of future revenues will continue to be generated by a limited number of customers. To mitigate this risk, the company is focusing on delivering more integrated system-level solutions to increase its value per customer. Management also believes that the company's cash and cash equivalents will provide sufficient capital to fund operations for at least the next 12 months. The company may use available cash for acquisitions or minority equity investments to further drive growth. Management acknowledges that the company will continue to experience exchange rate and currency fluctuations, but expects to hedge against these through its foreign currency cash flow hedging program. Overall, management's strategy is centered around delivering more integrated solutions and leveraging its existing portfolio to drive sustained growth. The company has made significant moves in its business strategy through acquisitions. Two notable examples of these acquisitions include the purchase of Hillcrest Labs and the acquisition of VisiSonic's business. These transactions have likely expanded the company's capabilities, products, or services, contributing to its growth and development. These acquisitions demonstrate the company's commitment to strategic expansion and innovation. By acquiring new businesses and technologies, the company is able to enhance its offerings and stay competitive in the market. The absence of divestitures suggests that the company has not felt the need to shed any assets or business units, indicating a high level of confidence in its current operations and strategy. The company's financial activities have been scrutinized in recent reports. One notable aspect is that the company has not engaged in share buybacks. This decision suggests that management may be prioritizing other uses for available funds. Regarding dividends, there is limited information available. The only mention of dividend distribution pertains to an Israeli subsidiary's future intentions, rather than any current or past actions by the parent company. As a result, it remains unclear whether the company has paid dividends in the past. There are growing concerns within the industry regarding inventory buildup. A specific area of concern is the accumulation of channel inventory in lower-tier smartphone segments. This issue has been highlighted in various reports, indicating a potential problem that needs to be addressed. The presence of excess inventory can have far-reaching consequences for businesses and the supply chain as a whole. It not only leads to financial losses, but also disrupts the smooth functioning of operations. In the context of lower-tier smartphone segments, this issue is particularly pressing due to its impact on profitability and market competitiveness. To mitigate these risks, companies must adopt strategies that effectively manage inventory levels and prevent accumulation. This may involve optimizing production schedules, improving forecasting techniques, or implementing more efficient supply chain management practices. By taking proactive steps, businesses can minimize the negative effects of inventory buildup and maintain a healthy balance in their operations. That concludes the financial summary for CEVA Inc. Feel free to comment below, and I will be happy to answer them when possible.